Interest rates are frozen, but the crisis is just beginning.
Okay, let's just jump right in. It feels like every single headline is pulling the economy in a completely different direction, right? You've got the Federal Reserve hitting the pause button, gas prices are just shooting through the roof, and the markets, well, they're getting some serious whiplash. So what is actually going on here? We're going to connect the dots and make sense of all the forces pulling at your wallet. I mean, it really does feel like a perfect storm of bad news. Just when we thought the Fed might start cutting rates, they slammed on the brakes. At the exact same time, we're seeing defaults in private credit start to creep up, and the price at the pump is making every single one of us wince. And then, to top it all off, Google searches for "can't sell a house" just hit an all-time high. Believe me, these are not just random events. So here's the billion-dollar question. How are all of these things, a central bank decision, consumer debt, gas prices, the housing market, how are they all tied together? Well, the answer starts with one single globally traded thing. To really get what's happening at this economic crossroads, we have to start right here. We have to talk about the huge inflationary power of oil.
Did freezing interest rates actually fix anything or just delay the crash?
You know, this quote just cuts right to the chase. The price of oil is pretty much the main trigger for so much of what we're all feeling right now. I mean, think about it. It's not just gas for your car. It's in the fertilizer for the food we eat. It's the fuel for the planes delivering our packages. And it's in the plastics for, well, almost everything we use. You just can't escape its influence. So when oil gets more expensive, it creates this massive ripple effect. The trucks delivering goods, the factories making them, even the farms growing our food, suddenly it all costs more to operate. And businesses, they're not just going to eat those costs. No way. They pass them right on to us, the consumers. And just like that, inflation, the very thing we thought was finally cooling off, gets a brand new shot of energy. And listen, this isn't just a hunch. We've got the hard data to prove it. Research straight from the Federal Reserve shows that for every 10% jump in the price of oil, the energy part of the Consumer Price Index, that's the CPI, it leaps by about 1.5%. And it happens almost immediately. That is a direct and super fast hit to the inflation numbers. So, of course, this brings us right back to the Federal Reserve. Because with oil prices pushing inflation back up, the Fed is now completely stuck between a rock and a hard place. They are facing one of their toughest calls in a very long time. Just look at this. On one side, you have all these signs of an economy that's slowing down. The job market is getting a little softer, people's personal savings are shrinking. All of those signs are screaming, cut interest rates, stimulate the economy. But then, on the other side, you've got surging oil prices reigniting inflation. And to fight that, the Fed would normally hold rates steady or even raise them. They are being pulled in two totally opposite directions at the same time. This whole mess has everyone whispering that one dreaded word, stagflation. It is truly the worst of both worlds. It's where your wallet gets hammered by rising prices while the risk of losing your job also goes up. Policymakers absolutely hate it because the very tools you use to fight inflation can make unemployment worse, and the tools you use to fight unemployment can make inflation worse. The situation right now is a textbook setup for this exact nightmare scenario, and it is what the Fed is desperately trying to avoid. Okay, so the Fed's in a bind, inflation is trying to make a comeback. How in the world are investors in the stock and housing markets supposed to react to all of this?
You know, the recent stock market pullback, it's not really because the Fed paused rate cuts. To be honest, most people saw that coming. The real problem, the real driver of the fear, is just pure uncertainty. How high will oil go? How long will it stay up there? What is the Fed going to do next? When nobody has the answers, investors tend to sell first and ask questions later.
Yeah, and the housing market is feeling this weirdness too. Inventory is finally starting to rise a bit, and demand is softening. In fact, the National Association of Realtors is now calling this the most balanced market in almost 10 years. Basically, that just means neither buyers nor sellers have a clear upper hand anymore. So prices are probably going to stay pretty flat for a while. But while the short term feels completely chaotic, history actually gives us some really valuable perspective. Check this out. This study from the Carson Group looked at 40 major geopolitical crises. On average, yeah, the market dipped, but less than 1% in the first month. Now look at the next 6 months. It actually went up by an average of over 3%. What this tells us is that markets tend to freak out and then digest the bad news and get back on their feet relatively quickly. So, let's pull all this together. What does the data really tell us? Well, it suggests that even though this moment feels totally unique and scary, the market's reaction to uncertainty is, well, it's a pretty well-worn pattern.
And maybe the most important thing to just keep in your head is this. Uncertainty, by its very nature, does not last forever. It can't. Eventually, things settle down, oil prices stabilize, and the path forward for the economy becomes a little bit clearer. This state of confusion we're in, it will pass.
And this quote just perfectly captures the whole long-term view. I mean, historically, some of the absolute best days in the market happen right after the absolute worst days. So if you panic and sell during a downturn, you often miss that powerful recovery that follows. The bigger risk isn't staying invested through the bumps, it's being on the sidelines when the big rebound happens.
So, it all leaves us with this one final crucial question. In a market that's just driven by frantic headlines and fear, is it possible that the most powerful move is to do nothing at all? History really seems to suggest that in times like these, patience isn't just a virtue, it's a strategy.